about 10 years ago, when SEBI asked mutual funds to disclose their votes on investee company resolutions, I remember reporting that 3 of the 5 largest mutual funds in the country did not disclose either the company name or the nature of the resolution they were voting on. They just simply disclosed whether they had been for or against the resolution. One large fund said it voted only 4 times in the year. I suppose it was invested in only 4 companies or even less. One fund voted in favor of every resolution and another abstained from all of them. That was 10 years ago. It was an embarrassment when all of this was reported across the media and the funds knew it. The disclosure requirements forced these funds to review their voting apathy, devise voting policies, and vote finally. Now, that in turn helped birth the proxy advisory firms that now offer recommendations to institutional investors on various corporate resolutions. Along the way, insurance companies were also asked to adopt stewardship policies and voting policies. And one more thing changed during that period, which is the ownership of India Inc. On the legal and regulatory side, we saw the fallout of Satyam in the Companies Act 2013 and much higher standards imposed by SEBI in its regulations that it aligned effectively with the Companies Act. Well, over these 10 years, we've seen a revolution, or maybe you can call it an evolution because it's been somewhat slow of sorts. Institutional investors amongst the investor body have become especially vocal. So whether it's Maruti, Suzuki, remember the Gujarat plant situation, or Tata Motors, remuneration of key managerial personnel, or Coal India with TCI funds, or more recently, just in the last year or so, Asian Paints on the ESOPs matter, Mindtree on ESOPs, Balaji Telefilms, again remuneration, Eicher Motors, again remuneration, Zomato, again ESOPs, and now even Reliance Industries, where one institutional investor is questioning the independence of a director who's been appointed on its board. So they're all facing investor activism of some sort or the other. Is this sustainable? Will it increase as the years go by? Where do we go from here? I have a stellar panel today to discuss what I'm calling the institutional investor uprising in entirely positive terms. Joining me is M. Damodaran, Chairman of Excellence Enablers, Sucheta Dalal, the editor of Money Life, and Amit Tandon, the founder and managing director of Proxy advisory firm IIS. To all 3 of you, a warm welcome to BloombergQuint in this discussion. Let me start by just this year itself. Mr. Damodaran, we've had a year of several resolutions put forward by companies, many of them large blue chip ones, being voted down by institutional investors. And even if they've eventually passed, thanks to promoter support, the institutional investor vote has registered clearly, thanks to all the media reporting that's gone on. What stands out most for you?
Firstly, let me congratulate you for using the word institutional shareholder activism. Almost the rest of the media calls it shareholder activism. And I think they're wide off the mark. Because you can see definitely that retail investors and institutional investors in a number of cases have voted differently. I will park that. I'll come back to that in a minute. This was just to tell you that as far as identifying the subject for discussion is concerned, you have been spot on. It is institutional shareholders that we're talking about. That is the focus. Secondly, I would like to believe that institutions suddenly woke up, discovered their strength, and started asserting themselves when it came to voting. I think activism, Amit is an old friend, he won't get me wrong. The activism has been on the part of the proxy advisory firms. A little before I came in here, I was looking at a report which quotes a leading institutional investor from outside of India saying to a company, I'm glad you brought this to our notice because we almost without exception vote as the advisory firm tells us to. So there is an admission of non-application of mine. That's fine. Second is the process. When they got the clarification that the company sent them, how did the company send it to them? Someone wrote to the company, there is this report where this proxy advisory firm, not an Indian firm, so we can breathe easy, outside of India, said you should vote against this resolution. Right. So the company wrote to them saying that, look, you have said this. We understand this is what you're saying because we have no copy of the report. So then there was a little bit of exchange of mails, etc. And then finally, the company, when they were told that this is the position, they said, we will refer it to the proxy advisory firm. And if they put out an addendum to the report, we will surely go along with the position that they take. Therefore, to cut a long story short, what we are really looking at is whose activism are we talking about? Are institutions applying their mind in respect of this and voting? I would stand up and applaud if they were doing it. No. I think it is the proxy advisory firms who are drawing their attention to resolutions which don't seem to be kosher, and almost mechanically they're voting without thinking about those resolutions. One more point I wanted to make is that when we talk and change over the last 10 years, you mentioned what has been prompted by regulation, that is better disclosure of voting patterns of mutual funds and insurance companies. But there are a whole lot of institutions outside which do not have any similar requirement. Are they disclosing enough on why they did what they did? Because if they did disclose why they voted, not how they voted, why they voted, the one-line answer would be, this is what we were told by the proxy advisory firm. I believe we will have time to revisit this issue, but I think institutions should not, to put it bluntly, outsource thinking and outsource decision. And I'll stop there.
All right, Mr. Damodaran, I think you already set the cat amongst the pigeons right at the very first answer itself. I believe this will become a big debating point, because there are instances where, in fact, the changes over the last 10 years, some of which I recounted in the introduction, have also prompted institutions to think hard about their voting policies. I studied quite, closely, let's say, the ESOP voting policy of mutual funds. And I think they made quite clear in many of their policies, if there is transparency, they will vote in favor of the ESOPs. But if there's opacity, or if it's very narrowly oriented towards just 2 or 3, top key managerial people, then they will vote against this. So there is some thinking on the institutional level, but point well taken. I'll come back to it in just a bit. The question I really was asking was there any corporate instance in the last, let's say, 6 months or a year that stood out for you, whether it was, Asian Paints or Mindtree, or now more recently Reliance or Balaji Telefilms in between? Or do you think that the big feature really is the fact that it's the proxy firms that are more activist than the institutional investors?
No, I think. Sorry, you want to go ahead?
No, please go ahead. I was asking if there was an instance of activism in the last 6 months to a year that stood out for you.
I think the issues are different in each of these. They're all important issues. But it's not as if we've had, for example, we've had the question of appointment or reappointment of directors. We've certainly had the issue of stock options. Executive compensation has been an issue. There have been other issues that delisting, for example, whether all cargo needs to delist or not, has been an issue. And I think we've seen a lot of pushback by institutional investors, in some cases, even by retail investors. And I have a few numbers with me that I will share a little while. But the one instance that I recall very fondly goes back well beyond 10 years. In fact, it was when I was chairman of Unit Trust. We had 2% plus shareholding in a company. The sector had done reasonably well. The company had done badly, and they wanted to pay twice the compensation to the managing director who was there. So we had 2%. We let it be known we would oppose the resolution. The management representatives came to see me and ended up by saying that anyway it will get passed. You only have 2%, everybody else is going to vote in favor. I said, go ahead, do that. But we will put out a press release saying that we voted against the resolution. It got passed because the majority didn't think there was much wrong with the resolution. They withdrew the resolution because of the 2%, call it the tail wagging the dog, whatever. There have been isolated instances even in the past, not too many. There have been isolated instances. I was waiting for a time when institutions would assert themselves. He also mentioned straight away, lest we miss this out, that in a number of companies, institutions taken together have a higher shareholding than the promoters.
Sure.
It's something you need to watch out for, because if promoters are completely neutralized by institutions ganging up, you're starting with the presumption that all promoters are bad elements. I'm not for a moment saying all of them are bathed in milk, far from that. But do you want to tar all of them with the same brush? Put them in the same predicament because they don't have as much of shareholding as the institutions have? And why do we believe that institutions will necessarily act right? If they go by Amit's advice, they might, but there are several others advising them, and then they might get it wrong. You never know with that.
Okay, fine. You've raised two important points. I'm going to throw it across to Sucheta. It's been a long period of change, Sucheta. What has stood out for you? And then, of course, I'm sure you will respond to Mr. Damodaran's points on this being more proxy advisory firm activism than institutional activism. And we'll come to the promoter and shareholding concern in a few minutes.
Okay, so I think Mr. Damodaran's point is well taken about it being institutional activism. But, there's a big but. I remember, I used to be a trustee in Consumer Education and Research Center of Ahmedabad. And this was one of the few organizations that was looking closely at what is happening in the investor space. This was the time when we had this big primary market collapse, vanishing companies and whatever. And I remember even interviewing Templeton, because we had this great hope that Templeton was active in other parts of the world, an activist, and that they would do the same in India. They seemed reluctant to do it. So I have a slight difference of opinion with Mr. Damodaran. I don't think it's a bad thing, that institutional investors are being active and that they depend on proxy advisors. This should change. Okay, so there I agree with him. It should change, but it cannot possibly change as long as the results season and AGMs are bunched together. So to expect small groups of people to go through everything really fast, I mean, of course, the flip side of the argument will be how many people do proxy advisors employ? I'm sure Amit Tandon is going to talk to us about it. So they are equally small. Why can't an institution which is so big and has shareholdings have a bunch of people internally doing it? Why do they depend on proxy advisors? Now, as you said in the opening, this started with SEBI rules. 3 people were waiting on the sidelines. And I remember one, I won't name names, came to meet me to talk about, setting up a company which is going to tell people how to vote. And I remember laughing at him and saying, why the hell do you think anyone's going to listen to you? They don't listen to us. I mean, I'm media, we write about it. It's in the public domain. It doesn't make a difference. Forget about the press release. So why will they listen to you? Why will anyone give you a consulting appointment? And a few months later, I realized how foolish I was, because SEBI came up with rules. And this company obviously knew all about the rules that were on the anvil, and they were ready and waiting and got registered. Okay, so obviously a ready-made market was created for them. One. Second is that unfortunately, we have only 3 proxy advisors in India, which means that if they do not take an activist stand, they have no business. Okay, I don't see why I would spend money if I were a company hiring a proxy advisor if they're not going to find things that need to stand out and make contrarian recommendations at times, look at things like ESOPs and salaries and stuff like that. The third point I want to make is that it's good to have it, because when an institutional investor wants to say no, SEBI has also ensured that proxy advisors aren't a law unto themselves by saying their reports have to go to companies. So Mr. Damodaran's example that, the company got another point of view and could respond to it. Those are the checks and balances that have come about later, which is again a good thing. It's an evolving process, all for the better. So I think that, if a company has to say, or an institutional investor has to reject a proxy advisor, it has to do that much of homework, because the fiduciary responsibility is a lot more. And in India, the judicial system doesn't work. So I, as a minority investor in a mutual fund, can't go and ask, take my fund to court, because it's too expensive and too slow. We know what happened with, how Franklin Templeton is dragging. But at least in the US, somebody would go to court and say, on what basis, when you had good advice from a proxy advisor, on what basis did you reject it? So you have to work twice as hard to reject a proxy advisor's advice. So that itself also acts like a check and balance. Final point that I want to make is, I completely agree with Mr. Damodaran that there are no retail investors, but I'm extremely hopeful. 1.5 crore new investors in the market since the pandemic is mind boggling. I mean, I remember writing forever, from the time UTI was still the big UTI it was, that we have 2 crore investors in India. It remained 2 crore until 2 years ago. 1.5 crore after that, and growing, is really a dramatic change. And with e-voting, with NSDL allowing you to do it, online, I think there are lots of forums online which are doing deep research. In fact, sometimes the research is so deep as to be ridiculous. They also act as a check on proxy advisors, incidentally. And these groups are putting out their views on a lot of things. Maybe they're not getting into stuff like ESOPs and all that as much, but they are very blunt. And if serious retail investors look at it, for the first time ever, we have an opportunity where potentially, I'm not saying it's happening, but they can get together and make a difference. So I think, it's a very rapidly evolving sort of space, and 1.5 year has made a big difference. And I think we're going to see a lot of change in the coming months or coming years.
Okay, great. I'll come back to the point of retail investors. I'll come back to the point of changes in shareholding or ownership of India Inc. But Amit Tandon, is this institutional investor uprising, or is it a proxy firm uprising? Is it more activism on your part? And are institutional investors really thinking through the votes they cast?
Right. So thanks a lot, Menaka, for the invitation. And clearly, we seem to be right at the center of the storm. So I'll kind of come back to the questions you asked about the role of proxy advisory firms, plus what we think about investors. But let me just begin with the question you asked, Mr. Damodaran, which kind of...
what stood out for you?
What stood out for me? So, clearly, while Z is still unfolding, we are watching it very clearly.
Yeah.
But the thing which has actually stood out for me is, two fairly venerable gentlemen in the market, Mr. Vinod Rai getting voted out, and the build-up of institutional votes against Mr. UK Sinha.
Right.
I think it's interesting because, I would say that, we ourselves kind of tiptoe around what these people do and don't necessarily call out instances. And I remember in the past when Mr. Vinod Rai joined the board of a bank when he was the chairman of the bank bureau. So we kind of tiptoed around issues, but didn't. But this was about 3 years, 4 years, 5 years ago. But now the fact that, the investors have kind of voted the way they have is a kind of, interesting development from, or at least a noteworthy development from my perspective. We've been kind of talking about this activism, etc., etc. I mean, you could say it began with Coal India. I have my take in terms of what had happened with ICI or Akzo Nobel way back in 2011 when we started, where they had they were merging some unlisted companies with themselves and increasing their shareholding. The investors kind of gave them some pushback. They decided that, okay, they kind of said, okay, we'll merge this, but we'll roll down the royalty, etc. So, where it originated, it's hard to say. But again, one of the things which has stood out for me is 2 years ago when, in the case of Fortis, because that is actually in a sense where investors were able to get together, ask for the removal of the directors because they felt they weren't doing right by them, and also ensure that prize the existing promoters who weren't just willing to let go from the company, prize them away from the company, and bring in a fresh management and governance structure to run the hospital. So that is where it is. Coming to the questions which Sucheta and Mr. Damodaran, I'd be happy if investors listen to us as is being alluded to, but unfortunately, when you kind of look at the data, there is, of course, they're kind of looking at, taking what we are saying much, much more seriously, because we take our responsibilities very seriously, and when we send out recommendations. So it's good that they do, but I think we still have a lot, some way to go there. On the fact that Mr. Damodaran spoke about the fact that institutions are kind of guided by the proxy advisory firms. When I kind of look at what has happened in our market, and I speak to people who are kind of not necessarily involved with the proxy advisory, but focused on governance or sustainability, and have been looking at this landscape for longer than I have. We see the particular story play out, which is the fact that first there is a regulatory push, or their unit holders and policy holders are kind of asking them, or the newspaper, because of media reports, investors start focusing on it. So it begins with a little bit of tick the box approach, and then over a period of time, as they kind of start looking at what is up for, what is being discussed, what the resolution is for, they kind of start internalizing it and start taking a more critical look at what happens. So just you spoke about the change in ESOPs. I'd say that when we began, we used to we had a view on borrowings, companies borrowing too much, but most institutional investors were saying that, look, this is a routine resolution, it's a management decision, we don't want to get into it. And then you suddenly saw the debt levels go up, companies defaulting, the dirty dozen, and its own, and companies suddenly started saying we're going to look at borrowing resolutions a little bit more closely. Let's look at director appointment. So far, we've seen different patterns of behavior. So the global investors focus a lot on the independent directors. The domestic investors turn around and say that, look, this company is run by Mr. Munjal or Mr. Bajaj or the TVS group, and therefore we're turning to the group to kind of to do something rather than the independent directors. But if you look at it this year, investors have started focusing, and domestic investors as well, as what is happening on the what is the behavior of individual directors, independent directors, what was expected of them, have they kind of delivered on what was expected or not, and therefore we're kind of starting to see a change in behavior.
Amit, can I briefly interrupt you? I think since you're talking about, let's say, for instance, different kinds of resolutions and institutional investors having reacted to many of these, sometimes vetoing them, can you respond to Mr. Damodaran's point on whether they're just blindly following proxy advice from firms like yours? Or do you believe that, with the evolution of policies by proxy firms, the policies of institutional investors have also changed? So they're putting some thought into this.
No, Menaka, that's what I'm saying. So, if we look at them over a period of time, while we have a view, and it's been more or less consistent, and I say it's consistent because, when you look from when we started to now, our vote against has been around in the 11% range. When we look at, from abstain to, supporting a lot of most of the resolutions, to now, when you see investor pushback, when you've started, resolutions may not get defeated, but there's still enough instances when, more than 50% or 40% of the institutional investors are voting against. So when I gave examples of borrowing or independent directors, it's not we've changed our policy, it's that investors have become a little bit more aware of some of these issues, and they kind of start thinking about what is it that's impacting the business. So they kind of look at succession planning more closely, capital allocation decisions more closely, what is the extent of dilution more closely. These are things which have kind of entered the conversation, which wasn't there 10 years ago. And finally coming to the question of to react to what Sucheta said, that look, there's a market for us or for our products, only if we are pointing out what has happened. Our view, the two things we've done from day one, we've kind of sent our recommendations to companies before we send it to investors, so that at the end of the day, the companies also cut paste from last year's resolution, even though that is not their intent. And a good example is what had happened in iShare, where they said, look, we've always had 3%, but 3% when profits are going up versus 3% when the profits are coming down is completely different. And therefore, when they brought the fresh resolution, they were more thoughtful about it to say that it's going to be 1.5. So we've always gone to companies, tried to speak to them, get them to comment on what we've said, so that we are able to give our clients, which are the investors, the right advice. The second is, for a lot of things, we kind of turn around and say the two things which guide us. One is the past is a guide to the future. So if you've got a particular, you see a particular pattern of behavior in the past, you would expect it to continue, rather than the company suddenly say that, look, we've taken this resolution 10 years in a row, but this year we are not going to do what we did in the last 10 years. So we give the company the benefit of doubt. And the second is, in a number of instances, we kind of flag it off as a governance issue. We say that, look, this is and a good example is, companies are supposed to give the auditor fees. A number of them don't. Now we say that, look, they're supposed to have given it, they haven't given it, but hey, let's go ahead. We know what they paid last time. We know what the broad fee levels in these companies are. Let's go ahead. We are approving. We suggest you vote for it, but let the company clarify at some stage. So we are not actually saying that let's create, let's kind of have a market for against. So yeah, it's a long answer, but I've kind of answered, addressed.
Okay, let me take this answer a little bit and some more points to both Mr. Damodaran and Sucheta for quick responses, because there is much more to discuss in this than just the role of proxy advisory firms, though it is a very important role. Mr. Damodaran, are you in some ways echoing the consternation in boardrooms that, let's pin this activism or whatever we may call it on proxy advisory firms, because we can't really confront institutional investors, and so proxy advisory firms are an easier fall guy in that sense. Because what's the harm, even if it is proxy advisory firms and their policies and their voting recommendations that have pushed institutional investors to become more aware? That's not a bad thing. I mean, many of the against votes that we've seen in the recent 6 months, 1 year, they seem to be based on reasonably rational thinking of, hey, this ESOP program is too opaque, or this remuneration for a loss-making company seems excessive, or that this independent director did not say anything whilst being on the audit committee to a variety of unpleasant transactions. There seem to be clear reasons for this. It isn't just, this is what I was told to vote, hence I voted.
No, I think you've raised a very important point. Firstly, let me say this in case I was not clear first time round. I am not exceedingly critical of proxy advisory firms. I think they're doing a great job. My worry really was that once they have done that job that they are doing and doing well, they are looking at evidence, they're thinking through what they are recommending. After that, does it then become rubber stamping at the level of institutions, or is there further application? Right? That was one. Okay. What has happened as a result of the recent voting patterns is that the major benefit is that boardrooms are now taking serious notice. They know the world has changed. They know that next time round, when you go with a resolution, firstly, you got to be satisfied that you are taking a resolution which is a bona fide resolution, and that you will be able to defend it either when a proxy advisory firm engages with you or when an institutional investor chooses to engage. You must have an answer. I must say that the amount of preparation in boardrooms is beginning to increase. And that's a good thing, that you're taking people outside the boardroom a little more seriously than you took them in the past. The second point arising out of what you said is, yes, there are issues on which you got to pull up boards. There are resolutions which in their content are clearly wrong. They're not in the interest of all stakeholders, or they're not spelled out. It's entirely possible that, a sense of overconfidence creeps in. Essence of the regulation might be right and might be something you can defend. But therefore, your explanatory memorandum is a very casually written. And the reader of that memorandum, not being an insider, doesn't know why you're doing what you're doing. And that sometimes tends to a negative vote. You go back and explain. The same resolution sometimes tends to get passed. We've had a case of two senior executives in the case of Tata's, where it was initially voted down, but when they went back, they explained this is what we were attempting to do, etc. After that, people said, okay, there seems to be some merit in this, we will not oppose. Not that they said we opposed it the first time, therefore we will. I think there's a lot of enlightened behavior on all sides. Two additional points, if I may. One is, we spoke about retail investors very briefly. What I wanted to mention is this. I have with me the voting patterns of a few companies. I won't trouble you with too many of them. But to think that that retail investors are sleeping, they should be woken up, is entirely incorrect. Take the case of a couple of years ago, the compensation of the chief operating officer and the whole-time director of Infosys. 67% of public non-institutions voted against. Only 25% of public institutions voted against. So you have an instance where retail investors, many of them without any external advice, have said, no, this is not something that we are going to support. If you actually get to HDFC and the celebrated case of the reappointment of Deepak Parekh a few years ago, look at the voting pattern. 75.14% of public institutions voted in favor. And since that was the large majority, he was fairly close to, coming to grief on that. The total results for were 77.36. He needed 75%.
Yeah.
But 100% of the retail investors voted in support. 100%. The voting pattern was 100 in favor and 0% votes. Like 0 means I think there was some 10 or 12 to take when you take it to the nearest percentage. Point I'm making is retail investors sometimes vote differently, sometimes vote in favor of a resolution that they think is right, not that they're consulting among themselves. Sometimes vote against a resolution in much larger numbers and institutions vote against them. So it's not that retail investors should be treated as a matter of minor detail. They too are, in some sense, not in too many cases, but in some sense. If you take UK Sinha's votes, for example, it's very interesting that in Vedanta, public institutions, 70.70% voted against the resolution.
Yes.
But it's not as if public non-institutions didn't assert themselves. 43.3% voted against the resolution. It's not that it was 5% or 10%. It was split down the middle. 56% for, 43%, 44 against. Therefore, let's not believe that all activism is what institutions alone are doing, though the celebratory atmosphere about resolutions being defeated. Now, to my mind, activism is not only when you vote against resolutions. That man bites dog being used, dog bites man not being used, is somehow impacting the way we look at this.
But where are you picking up the celebratory atmosphere, sir?
Oh, in the newspapers, the editorials, the articles which say this has been voted out. I mean, it is almost as if there is a kind of, shall we say, delight that somebody has been brought down to his knees. That's the kind of reportage that one sees. I'm not saying across the board, nothing is ever generalized.
Sure.
There are instances, okay.
But may I offer a defense on behalf of my newspaper?
May I will give you 30 seconds more and I will let you say what.
Yes, please do.
Two things I wanted to ask you. What is activism? To my mind, activism means more people should vote. Just look at abstentions, and I think you mentioned abstentions. When the Cyrus Smith 3 vote took place in Tata Consultancy Services AGM, 43.31% of institutions abstained. It was a sufficiently serious resolution. I'm not taking sides. Maybe Cyrus was right, maybe Tata was right. This is not the forum for that. But the point is 43% decided not to vote. That's not responsible behavior. I am of the view that when it comes to institutions, maybe retail investors at some level have some excuse. Maybe you don't know how to handle the NSDL platform, whatever, access to a computer, you were busy. Institutions, abstention to my mind is abdication. Some people have given money to you. You have to vote on their behalf.
Yeah.
They are your investors. You exist as an institution because of them, and then say, sorry, I am not voting. That's not good enough, but I took more than 30 seconds.
No, please, we do have more time, and I'll come back to that. I agree with you, in fact, that retail investors are voting. In most recently, in the case of Zomato, I think this was barely a few days ago, we saw both public institutional shareholders vote one way and non-institutional shareholders vote another way, and 96% of that company is public held. There is no identifiable promoter there. So there is hope that retail investors are also joining this activism, if I may call it that. But I'm going to dwell for a minute on this celebratory point that you made. And I want to know how boards are looking at what's going on. Sucheta, are boards taking what's going on?
If I may, before, sorry, I just want to clarify that the other is not necessarily retail investors. So it could
be corporate bodies and things like that.
ESOP,
ESOP. Mostly, no, we divided that.
Yeah. So just to put that on the table.
Yeah, sure. No, I mean, retail is one element of the others.
Before you bring in Sucheta, a 5-second comment when you mentioned Zomato. Institutions don't eat, individuals eat. That explains the voting pattern.
Okay, maybe. Sucheta, Mr. Damodaran said something interesting. It seems celebratory. In the defense of the media, I think maybe it's just a sense of reckoning or relief that institutional investors are finding a voice, whichever way they vote, for or against. How do you think boards are interpreting all of this that's happened over the last year or so as this activism is picked up?
Well, I'm sure boards don't like it. But, if you ask me, I think it's wonderful that media is celebrating the fact that institutions are finally voting and bringing a few people down. I mean, I've covered markets for 35 years, and I think corporate India has got away with absolute murder. We have seen how they have happily diverted money, they have bribed banks, they have bribed government people. They got away with doing whatever they want to, set up new companies, whatever the rules. They took away equity, for their diversifications. I remember somebody senior in the Tatas once talking about one of India's largest groups and say, how does the promoter manage to have the kind of equity he does while we struggle to keep our equity portion high because we don't break the rules? So I think it deserves some celebration if a few people are booted out. And it's a wonderful thing that media is not whining about it and celebrating it. That's one. The second point I gather from what Mr. Damodaran and Amit Tandon have said is obviously there seem to be big loopholes that still need to be fixed. So maybe because even you to an extent painted proxy advisors as bad guys, Amit Tandon is being needlessly defensive about what they say. But if you ask me, from what I hear, from what he said, institutions are still not listening to all the recommendations. Okay. And I think that this is a bad thing. So if you ask me, this is a loophole that SEBI needs to plug, because most institutions have a fiduciary duty to millions of shareholders. And I'm sure they want to know that, why they didn't they did or didn't do certain things so that a Franklin Templeton kind of situation does not occur. So I would say that SEBI should make it mandatory for all proxy advisors reports to be out there in the public domain so that the retail people also know what they said and they then know which recommendations were accepted by institutions and which weren't. Mr. Damodaran's point about the Tatas, I think it's outrageous that, they abstained. And I think retail investors in the mutual funds and whatever have a right to know, even the insurance holders, why were you keeping quiet? Why didn't you act? Why this nonsense about governance and, so many corporate governance committees if you're not going to follow the rules? The third point that I want to make is, you can have any number of disclosures. Even now, corporate India does not disclose. So one of the things that came out yesterday, for instance, was that the second letter that was written by Invesco to Z was not sent to stock exchanges. This happens all the time. So you have lots of regulations on paper. There is zero monitoring. So for instance, I was looking at a broker default and I was horrified to discover that the broker was a listed entity on the stock exchange. So I went to the disclosures that they are supposed to make. The broking firm is declared a defaulter and there's absolutely no information. So I asked someone senior in the stock exchange, all off the record, how come there are no disclosures? What on earth are you guys doing? Are you not asking them? You have declared them a defaulter and there is nothing that's a listed entity. So the answer was, well, I don't think broking is the only business they do. So I did more research and I went back and said, in fact, broking is the only business they do. Okay. So what is the point in these endless rules? For a short while, I was an independent director in a company. On day one, I'm meeting all the directors for the first time. There is a form that we had to fill. I'm sure Mr. Damodaran has filled n number of them, but he probably knows people around the board. I was meeting, barring one, I was meeting all of them for the first time, and I'm supposed to rate them on a scale of 1 to 10. And I'm like, hello, I've met these guys now. Am I supposed to rate them on their biodata? What have I seen today? It's an introductory meeting. So mindless stuff which has come in the third Uday Kota committee recommendations and accepted. I think SEBI needs to rethink a little bit. So it needs to plug these loopholes about disclosure. It needs to eliminate all these checkbox-based nonsense that companies are wasting so much of time doing so that it's practical. They want exams for independent directors. What is happening in Z today? I mean, the directors are acting as though the largest investor is an aggressor or an enemy or, a hostile takeover artist. I mean, where is the independence? I heard of another company where a very, very well-known blue chip company where apparently one person sits in at every meeting and it's never recorded. Who are these independent directors? How is it never recorded? I mean, it's impossible to verify this information, but lots of people I spoke to say, yes, this is happening and happening for a number of years. So checkbox-based governance doesn't work. Instead, I think proxy reports should be put out in the public domain so that people can be held accountable. And of course, our judicial system has to be fixed because even if I catch my institution not voting the way they should, there's very little I can do as an investor. That's why I'm very hopeful that with the NSDL kind of thing and new savvy investors, all of them younger, tech savvy, are going to go there and vote, are going to, probably use social media to form a force. And we've seen it happening abroad. It's a matter of time before it happens. And I hope it's going to happen here.
Okay, great. I'm neither celebratory, to be honest, nor am I putting proxy advisory firms on the defensive because I'm deeply appreciative of the work that they do. We may not all agree with all the viewpoints at all points in time, but I definitely have seen the evolution over the last 10, 12 years, which brings me, to a collection of all the issues that you all have raised to one question. And I'll put this to you, Amit. Is this sustainable? What we've seen in terms of investors waking up, institutional, sometimes also retail, making their voices heard, sometimes in the right way, sometimes maybe not enough. Is this sustainable? Because we have seen ownership pattern changes over the course of the last decade or two. And I'm wondering whether they all point to more institutional holding and therefore more opportunities for such activism. Or do you think that, at some point, promoters are going to push back in a hard way?
My sense is that, we've kind of started going down a particular path, and we will continue to go down that path. It kind
Sure.
of, as you say, it's the shareholding pattern which is changing. So it's more institutional shareholders. It's more AIFs, others, as Sucheta pointed out, that you've got a set of young millennials and young people who've kind of started entering, who have entered the market now, and it's going to be a matter of time before they kind of start exercising their franchise. The other trend is that, what is unique about the trend we've been seeing is that we are kind of getting away from this whole thing of promoters. And I'm not talking about the legal definition of what SEBI is doing, but the fact that they're promoter-less companies which are increasingly getting listed. So
Yeah.
you have, companies like Zomato, where the CEO and the old team hold about, 5 to 7% equity. You've seen Paytm is wanting to list without anyone being called a promoter. So as the market changes, as the characteristic of the market changes, as its nature changes, you will have many such companies. Going back to the Zomato example, 60% of the institutional investors voted against. Now the resolution went through because you had a bunch of the existing shareholders, private equity players who supported them, who actually are now asking for significant control over the board through the resolutions, which is what supported the resolution. Now, I can imagine that 3 years, 5 years, they will sell their equity. Once they sell, what happens? So I think we've embarked on a path. The other way of thinking about it is that you look at some of the companies where promoters own 50, 55, 60% equity, and some of these are incredibly well run. But I can imagine a period when there will be capital calls, and when there are capital calls, what is the ability of the promoter to kind of maintain their shareholding? They will get diluted, and you've got the next generation coming in when they're 2 or 3 sons and daughters, where the shares will get divided. And therefore, my sense is we are kind of getting there. Whether we reach there in 5 years or 15 years is anybody's guess. But make no mistake, the direction is very clear.
Mr. Damodaran, you think this might in fact prompt promoters to relook at how the kind of shareholding levels they have, so that the resolutions they want to pass are passed, though that might become tougher and tougher because more and more resolutions are becoming special resolutions and require 75% approval, whether it is what will happen in terms of independent director reappointments starting next year, or even the recent changes that the SEBI board approved to related party transactions, which bring more RPTs, under the scope of shareholder approval.
Now, to your earlier question, which you asked, Amit, the short answer is, I think it's sustainable.
Okay.
More importantly, I think it should be supported in order to remain sustainable. If there is any fear that the enthusiasm is going to decline, I think there must be enough people to ensure that shareholders, other than the promoters, get their voice heard and are able to express their point of view by voting on resolutions. Institutions, non-institutions, whoever. My real concern is this business of not adequate voting. And I think there should be, we are talking about disclosures. I think after every AGM, maybe not the next day, but if it's put out 3 days later, no harm. Put out a list of institutions that abstained from the proceedings. Let the world see that these are acting in a representative capacity. It's not their money. It's the money of other people. So if they have not voted, put the name out there. Let them explain to the world why they didn't. And then you will find more voting. More voting is important. As for your question about promoters, to the extent that they can increase the shareholding, I'm sure they will try to increase the shareholding. Not just for the reason that the resolutions might be getting voted out. But more importantly, behavior in the boardroom, and I can tell you this with confidence, I've spoken to a lot of people. There is genuine worry that if you don't think through your resolutions properly, if you are not able to explain it, firstly, if you are not able to buy into it, that this resolution is a worthwhile resolution. If you are not able to explain it suitably by engaging with your stakeholders, whoever, you could come to grief. That recognition, I think, is there in boardrooms. There will be some pushback. Some people will push back. That again is a function of the voting pattern. If I am a promoter and my group has 60%, I will say, you say what you like, you write what you like. Okay, I will have some work to do on the special resolutions, but the other ones I'll be able to get through on my voting power itself. If God forbid I'm close to 75 and I need only to shore up a little bit here or there, what would I worry about voting patterns? But by and large, I think boardrooms, forget promoters, because who brings the resolutions to the AGM? It's the boards that bring. It's not the promoter that brings. Boards are beginning to know that there is going to be impact on the credibility, on the way they run the business, if they bring unsustainable propositions to AGM. Some will get voted out. Even the best resolution sometimes will get voted out. That's par for the course. But by and large, you will see better thought out resolutions and better explained resolutions.
How do you view the sustainability of this, Sucheta, given the fact that we are going to see, a higher voting threshold required for independent directors next year onwards, more RPTs coming under shareholder scrutiny, again, hopefully, next year onwards. All of these changes are just going to give more opportunity to institutional investors, actually all investors, to make their voice heard, right?
Yes and no. I think it's going to be tough because 75 is a high threshold, and to gather that much of votes is going to be difficult, unlike today. So this movement, for want of a better word, needs to work more systematically, gather momentum, and you need to have retail investors come together to become a voice. Because until retail investors do that, it's not going to they're not going to add their weight to the institutions. And I completely agree with Mr. Damodaran that abstaining is not an option. It has to be out in the public domain what they did. In fact, I would go a step further and say that proxy recommendations should be in the public domain for everyone to see, and the institutional voting on it. So at least if I am a unit holder of a particular mutual fund, I should have access to both coming into me on email, because I should know what was the advice and what my fund manager did. So I think it'll then come out in the public domain. It's not that one has to put it up on the BSC or NSC website, but there should be more transparency for this to sustain. Otherwise, there would be a bit of pushback from next year, I feel.
Okay, and there's also one other aspect I wanted to bring in. We're seeing more mutual fund voting, active voting in that sense, but not all aspects of the market, like Mr. Damodaran pointed out, are as aware of their fiduciary duty or exercising it as clearly. For instance, in a large number of insurance companies, they just choose to abstain. So there is some regulatory, sort of reform or push required in those areas as well, right?
Absolutely. Like I said, SEBI does not monitor, right? So SEBI does not even monitor what disclosures companies are making. They're supposed to disclose things. Not everything is being disclosed, and it's not monitored. So until SEBI, IRDA, PFRDA, and others point out and punish, and they make people understand that failing in your fiduciary responsibility is going to have consequences. But where have you seen action against even trustees of mutual funds so far? Hardly anything.
Okay, fair point. Amit, you said
I just come in. I mean, SEBI did a few months ago ask mutual funds to vote on. They said abstain is not an option. So, Sucheta, that's
so passive. Even passive funds have been asked.
Yeah, even for passive funds. So one of the things we saw was that the passive funds weren't voting. And they've kind of asked everyone to vote. The pension regulator, pension funds, of course, we've seen that their voting percentage is high, which leaves the insurance companies. So hopefully IRDA will take that same message and get the insurance companies to vote. There, of course, the big daddy is LIC. That's where the main corpus of equity is, because there's, I mean, there'll be about 20 or 25 insurance companies who have an equity corpus of less than 200 or 300 crores. So it's not going to move the needle. But yeah, we need to see that happen.
Okay, so I'm going to get very quick last comments from you because I think we've covered the variety of issues that I had set out to cover. Maybe looking down the next 6 months, 1 year, the kind of changes that you expect. And Amit, I'll go with you first. Are more boards engaging with you? Are more companies engaging with you? Are they defensive about the recommendations you'll make? Or are they more accepting of this different point of view and these higher standards that they have to adhere to?
Uh, one of the observations we had this year, I kind of say that we've had a very grueling voting season. And one of the reasons is that companies have kind of come back to us. And, one is, of course, as I mentioned, we kind of speak to them, but also there is now this regulatory change in process where after we send out our recommendation, they can, write to us and they're obliged to carry their view to the investors. So, a couple of things. One is the fact that, even if you're voting for, they, will call up and say, can we tweak the language? Can we put the comma here, full stop there? Of course, not counting on the addendums, etc. I think there was one company where we saw 3 addendums which were filed. It was virtually, till you say yes, we'll kind of keep filing these addendums on the stock exchanges. Of course, it's also mean that some of the companies, and I'm really appalled that their behavior towards our analyst has been a little bit abusive. So, in fact, when we kind of put out a note to clients this 2 days ago to say that we are changing our policy, that if someone is abusive, we may not kind of continue to have a conversation with them going forward. Some of these companies, unfortunately, tend to be owned by some of the larger PE funds, and maybe it's that which is kind of, it's money which is speaking rather than any rationale. But yes, companies have been taking what we are saying seriously. They have been reacting. They have been putting out more addendums. And I think next year, hopefully, the lessons of this season would be taken home when before they come to shareholders, they will have done their homework and change the contours of the resolution. I keep saying, have the shareholder in the room when you're, at least in your room mentally, when you're drafting the resolution, whatever information you think they might want to ask, if you can explain it right in the front, it's going to save everyone a lot of grief.
Sucheta, last thoughts on this?
I'm hopeful that things will change because, like I said, there are new investors who come into the market. Today, most of them are just trading. And in a bull market, everybody is a genius. But, over time, they're going to have to wake up to identifying good companies, segregating portfolios, looking at long-term investment. So the youngsters who come today at the age of 22 and want to trade, in another 4 years, they want some safer investments for the long term, and then they're going to start looking at voting. So I'm hopeful that with technology and with a lot of information being in the public domain, at least the good companies are going to be watched very carefully. But it's a stock market. So the way I see it, some of the bad companies, will come, raise money, and probably eventually get delisted, because when you are an investor, by and large, you want to vote with your feet. You don't want to turn into an activist. It's not like electricity that you need. You can always get rid of your share, right? So to that extent, there's always going to be a hurdle, because there's going to be one class of people who will say, I don't like the management, I sell the share. There's going to be another bunch of people who will say, what the hell, I'm co-owner, and why will they not behave, and I'm going to fight. So there's always going to be divided investors. So the brunt of this has to be institutional investors who have to be made to fulfill their fiduciary role. And that can only happen by more disclosures. Like Mr. Damodaran said, abstaining should not be an option. All the regulators have to ensure this. Maybe the insurance regulator has to be woken up. I think there's regulatory capture over there. Maybe when LIC is privatized, things will change. But when that happens, and when there is more disclosure in the public domain, things may begin to change. I'm hopeful.
Okay. Mr. Damodaran, the other thing that makes me hopeful is that over the last 10 years, we used to see institutional investors, vocalize their opposition against many of the smaller companies. But today we're seeing it against what are often labeled as blue chip companies as well. So from Asian Paints to Eicher Motors, to now even Reliance Industries that has been put on notice for seeking to, term a director appointment as independent, whereas Glass Lewis does not think that that director should be termed as independent. We're seeing even the largest of companies in India face shareholder opposition, or at least, let me put it more constructively, questioning on the way they're going about doing business.
I think that's a good development, and the more we see of that, the better it will be. There will be more transparency, there will be more disclosure, there will be more keeping in mind the interest of the persons outside the board and not just the persons within the board. Thinking of it's not what's in it for us, what's in it for our entire stakeholder community. That will come if the tougher questions get asked. But I wanted to make one last comment, which is,
sure,
if the ability of the average retail investor to stay and fight is limited, if he or she is very unhappy with the way a company is run, so a retail investor, if he or she is unhappy, should be expected to vote with their feet. An institutional investor shouldn't take that easy option. They should stay and vote with their hands. That's the only way you get better. Voting with the feet should be an option for the person who, because of circumstances, is weaker. Strong mind, strong commitment, but not the resources to continue the good fight. So let the institutions fight, let them show the way. And then you will find, as Sucheta said, retail will join the movement when it sees that its rights are what somebody else is fighting for. I see good times ahead. But one last caution. I think whatever regulations we do, it must be pragmatic. 75% stipulation from January 1st will drive away a lot of potentially, let's say, good directors, assuming there is a category called good directors. Many people who are being invited to join boards might say, I've looked at the shareholding pattern. Do I want to take this chance and get voted out? They might not. That's one possibility. Second, my request to Amit is, if the regulator, let's presume application of mind on the part of the regulator. Presume. Rebuttable presumption, as lawyers would call it, nevertheless. But if a regulator says that you can be on X number of boards, should a proxy advisory firm say, vote against that director if he is on maybe the number of boards that the regulator stipulates as a maximum, but is more than what a proxy advisory firm thinks is appropriate? I'm not saying who is right, but somebody ex officio has put a number. They're saying you can be on 7 listed entities. Let me make a statement. I am not on 7 listed entities, so I can state it subjectively. There are a number of people I know. But should they then say, no, if you're on more than 5, you should? I would urge that proxy advisory firms should, at one level, fly the regulator's flag also, rather than creating this kind of a division.
But isn't it good that they have higher standards, sir?
It is good, but if you say vote against somebody because he or she is on, let's say, 6 boards or getting onto a 6th board, as against 7 that the regulator has stipulated, is that a good thing or a bad thing?
So kind of, I was hoping not to get into the specifics, but let me. So our guidelines.
I wanted to bring you into this.
No,
yes.
no, our guidelines currently do say, if regulations permit 7, we are okay with 7. We keep debating whether we should change it and bring it down to 5. One of the thoughts which I have is that if we do it, we need to give the market, we can't spring it on them next year. We need to give the market 1 or 2 years, or maybe we can wait for 2024. So announce it and say that it kicks in over a period of time. But this year, where we did move the needle as far as our own internal guidelines is that, look, if someone is a senior partner in a law firm or in an audit firm or has a full-time role, we kind of said that, look, the same rules as an executive director should apply. Okay. So you should be on 3 boards. You should not be, you can't say that, look, I'm not the CEO or the executive director of a listed company, and therefore I can be on 7 boards, because some of them do have full-time responsibilities as a senior partner in one of these firms, and therefore we've kind of said it should be 3. Otherwise, I speak for myself. It is still 7. It's a little too much, but I can promise you we'll not kind of pull the rug on that. We will give the market enough time to adjust to our rethink on that as and when it happens, and if it does.
I agree 200% with what you said as far as professionals concerned.
I have a quick point on that. I agree with Mr. Damodaran, and I think it's completely wrong that proxy advisors are going to make the rules, because usually when a regulator makes rules, at least on paper, there's a multidisciplinary committee that discusses it and then they frame rules. So to think that 3 proxy advisory firms will act as a super regulator and make their own rules after being represented in those committees. In fact, one of the things that SEBI for certain has done is they have used proxy advisors as a proxy for all retail investors. So they are the only ones represented today. So you want a change, you go back to SEBI and ensure that there is a legal change. You can't make your own rules and you can't say, I have a higher standard. I'm sorry, I don't think that cuts ice, according to me.
Well, that is maybe Menaka's next program, but that's a different program, and we can discuss it with specific examples and where it works and how we are approaching things. Where do we have higher standards? Where are the instances where we go along with guidelines? In fact, if you look at our voting recommendations,
so we should
now started including,
I just said, a separate program.
Yeah, we should, Sucheta. We've actually started including a box saying that, what are the standards, and if our standards are different, why are they different, and what are we hoping to achieve? I can actually maybe collate it together in one document and send it across to you. But I would say that in most instances, we are aligned with the regulation. So we are not saying that, look, you've not separated the chairman from the managing director, this will happen next year, and therefore we are voting against the appointment. But if you come to me this year saying that, look, from next May, I'm going to do it, I might say that, look, yeah, we are supportive, but please note next year the regulations change. So therefore, I hope you've thought about it and you'll bring about change.
Okay, I'm going to hold you all to a follow-up program at some point in time, looking at some of the differences in standards. But I think we've reached some broad consensus that there definitely is an institutional investor uprising, even if it's fueled by proxy advisory firms who have become far more active and who've played a far bigger role over the last decade or so in the space of corporate governance, which is not a bad thing at all. It is, in fact, a good thing. Retail investors will hopefully join this bandwagon, if I may call it that. And there is so much more to go. I think next year we will see maybe even more instances than we have this year, which has been a record so far, of institutional investors finally having the power to vocalize their thoughts and the votes to be able to block resolutions that they don't agree with. How promoters and boards react to that is still work in progress. Thank you to all 3 of you for joining us on BloombergQuint and for your very, very candid thoughts.
Bye-bye. Thank you.